Hey folks, welcome to the Rate Update with Dan Frio. I, of course, am Dan Frio. Today is December 3rd, 2021. We're going to go over the jobs report and how that's affecting the markets next, so don't go away. Okay, to start out the day, we're going to talk the headline news. The job growth disappoints in November. And so let's listen to my friend Rick Santelli go over those numbers for us. Take it away, Rick.
November jobs report is coming out. 210,000 on non-farm payrolls, a huge miss. 235,000 on private payrolls. And if we look at what's going on with regard to the change in manufacturing, 31,000. That's also a bit of a miss. Now let's get to the meat of this, and here is some good news. The unemployment rate, U3 as we call it, 4.2. 4.2. Keep in mind that if you go pre-pandemic, we were at 3.5 in February of 20 and 4.4 in March of 20. So arguably, we're testing those levels. 0.3 is your month-over-month hourly earnings. That's on the light side. And 4.8 year-over-year hourly earnings, also on the light side, but historically very strong. If we look at work week, 34.8 is the average hours, and that definitely ticked up about 1/10. And another very important number, labor force participation rate. We did see a tick up, 61.8. 61.8. That is a post-COVID high. Pre-COVID, in February, we were at 63.3. And finally, U6, our underemployment rate, moving big time from 8.3 to 7.8. That's also a post-pandemic low. Jobs light, a lot of the other metrics, came in about as expected. Some of them were a little bit stronger, like U6, the drop in the unemployment rate. We see interest rates haven't really moved that much. You see the curve actually wiggling a bit. You see more of a drop in yields in 2-year, at least for the moment, than you do in 10s and 30s. Maybe we'll take out a little of that flatness, but flat is obviously the word on the yield curve. Back to the gang.
Rick, thanks. Let's bring in the rest of our panel. Steve, I want to start with you because so much to dig through in these numbers. You heard that headline number of...
We're going to go over the 30-year, 15-year FHA, VA, jumbo, and the 5-year ARMs. I'm going to put on my Bubbles glasses. My kids call me Bubbles when I put these things on. So let's see. The 30-year is up 3 basis points. If you look across this line right here, it'll tell you today's rate, yesterday's rate, and the change. Okay, though these are not my rates. These are the rates throughout the country surveyed by Mortgage News Daily. So you go across here and let's phrase this one, 3.21. Obviously, you know what that is. We reference this change right here of 0.03. We call that 3 basis points, okay? When you get down to the 5-year ARM, the 0.13 is we call 13 basis points, okay? So follow me on that one. So the 30-year right now is 3.21, 15.257, FHA/VA's 2.88, Jumbo's 3.13, and the 5-year ARM is at 3. 5-year ARM is so volatile right now because it's tracked by the short end of the curve, and the 30-year and everything else, or a lot of these other things, are on the longer end of the shelf. Okay, so that's what's affecting these things. The 5-year ARM's all over the map. It is about 20 basis points lower right now than the ARMs or the 30-year fixed. I apologize, I keep looking over here. I'm going to get this because my screens are going to come together eventually. So that's where we are right now. Okay, so let's see what this is doing to the markets. Right now we have the MBS market down 8, and if you don't know about what the MBS market, please check my other videos. I explain in detail what this is and why we watch this. It's the biggest component. This right here is the bond that trades on Wall Street that is the determinant of your mortgage rate. Okay, this is the biggest determinant. Let's make it that way. So what happens here is when the price of the bond goes down, rates go up. There's an inverse, what we call an inverse relationship. So down 8, no big deal. But if you go down through here, this is the last quarter. You can see this week has been crazy, but it's pretty in a tight little range here. It looks like. It's not that tight because if you break down on the side, we range from a 102, if you see here, behind my head, a 102 up to a 102.5. That's 50 basis points. It's a pretty big move there, okay? So that's the trading range that we're in now. All right, we want this to move up. I keep saying we should be trading at a coupon of 102.4. Okay, we were there, we exceeded that, and then the Omicron virus snuck its ugly head in there. So I'll give you my thoughts here in just a minute. Let's get on to the next piece of the puzzle. Let's see what the economic calendar was for today. I already did this, but I had to reboot my computer, so bear with me 1 second. We have non-farm payrolls. Last month's was 540,000. The prediction was 550,000. We came in at 210. You expect that to be, if you expected your paycheck to be $546, or last month it was, then you thought, okay, I'm going to get 550 this week, and it came back at 210. You'd probably be a little pissed off. Sorry about that language. So it's not a good number, no matter how they squeak this thing out. The good news is earnings are up. Okay, so that's pretty good. They're up 4.8 on the year. Inflation's like 6, 7, 8, 9. So you're not even keeping up with inflation. Keep that in mind. And then we also come here to the unemployment rate. Is they're saying it's down from 4.6 last month. The consensus was 4.5. Remember, the consensus thought we were going to add over 500,000 jobs. We added 200, and the unemployment rate miraculously went down. So go figure. Okay, so that's why I'm trying to give you guys the scoop, the skinny, the facts behind everything. Just because you see headline numbers like this doesn't mean things are good. Okay, the day changed. Let's look at the intraday. This is nuts right now. It is spiking all over the place. So let's dig into the whole day right now, and you're going to see, look at these candlesticks, and then you have the little lines below those. This is heavy selling. This is heavy activity. A lot of people were just sitting on the sideline until the number came out. It did, and then everybody started reacting. So it stabilized. We were down about 20 or 30 at one point, and then we recovered back through here. All right, so that's my morning update on where rates are, what my expectations are for the day. Let's go back to here. I think I see this number not being good. The thing that I'm seeing behind the scenes is, because this number is so bad, maybe when the Fed meets in December, they come in and say, we got the Omicron virus, we have employment that's not good, or the jobs aren't coming back like we thought. Maybe we shouldn't taper. And there'll be naysayers out there and then pro people on that. The thing is, we don't know what is going to happen. My thought is they're going to come out in the December meeting, but they're going to compile data in the next 2 weeks, and this data is very important. So that's why today's job number is important. So later this afternoon, I'll do a video bringing you up to speed on where we are with the markets, and then some news about some different programs that we're offering right now this month, specials to you guys. So check it out. If you like my videos, please give me a thumbs up, subscribe down below, hit the bell every time I post a video. You get an alert. I'll see you then, guys. Bye-bye.